Imagine you've spent, I don't know, your entire adult life diligently filling up this massive swimming pool in your backyard.
Okay, I am picturing it. A very big pool.
Right. So every single month, you bring out a bucket of water, you pour it in, and over 30 or 40 years, that pool is finally, full to the brim.
Sounds exhausting, but yeah, it's full.
Exactly. Now you reach retirement, and you want to start watering your garden, but instead of just dipping a hose into that massive full pool you already own, you drive down to the local hardware store.
Wait, why would you do that?
Right. You go there, you buy a brand new, incredibly heavy tank of water, and you drag it all the way home, just completely straining your back in the process.
It totally defies logic. I mean, you have a massive reservoir of resources sitting right there, yet you're choosing to take on a brand new heavy burden just to accomplish a really simple goal.
That is the perfect way to frame what we are looking at today, because we are tracking a massive systemic shift happening right in front of us regarding how the 55 and older demographic buys real estate.
Yeah, it's a huge shift.
And today's deep dive is built on a really fascinating stack of sources. We have a highly detailed March 2026 presentation from Longbridge Financial. It details a proprietary loan product called Platinum Peak, complete with all their internal pipeline data.
Which is pretty rare to see, honestly.
It is. And we are also pulling from a revealing snippet of a grassroots marketing webinar featuring industry veterans Rob Cooper and Andy Gerasi.
Right. And the combination of those two sources, it gives us a really rare look at both the macro level financial mechanics and then the actual on-the-ground psychology of how these homes are being sold.
So our mission today is to unpack this massive opportunity gap in the housing market, break down the nuts and bolts of a new financial tool, trying to bridge that gap, and basically figure out what this means for you. Whether you're personally navigating retirement financing or, working within the real estate industry. Okay, let's unpack this.
Let's do it.
We really need to start by looking at the sheer scale of this demographic disconnect because the numbers in this presentation are wild.
Staggering is the word I'd use. I mean, if we look at the broader housing market data from 2024, 53% of all homes purchased were bought by people aged 55 and older.
Wait, 53%? Over half?
Over half. More than half the entire real estate market is driven by this single demographic.
But here's the statistic that literally made me do a double take. Out of all those purchases made by that 55-plus crowd, only 0.067% utilized a HECM for purchase loan.
It's basically a statistical ghost.
Yeah.
And for anyone unfamiliar, HECM stands for Home Equity Conversion Mortgage. It is the government-insured standard FHA reverse mortgage.
Right.
The program was specifically designed to help older Americans buy a new home without taking on a new monthly mortgage payment, using the equity they've built up. Basically, dipping the hose into that swimming pool, to use your metaphor.
Yet nobody is turning the spigot. I mean, I am looking at the data table provided in the Longbridge presentation tracking FHA HECM endorsements from 2009 to 2025. In 2025, there were 28,149 total HECM endorsements. Out of those, a measly 1,540 were actually used for a purchase. Wow.
The rest were just traditional refinances. And all of this is happening in a housing market that is visibly tightening. The sources note that in 2025, existing home sales were down 2.09%, and new construction sales dipped by 1.1%.
Right. So cash is king right now. And what's fascinating here is that the market itself hasn't failed the demographic. The traditional financial product has failed them.
How so?
Well, the standard FHA-insured HECM simply isn't engineered for the diverse, modern needs of today's senior homebuyers. I mean, it carries way too much friction, too many bureaucratic restrictions, and frankly, enormous upfront costs.
So it's like an entire generation has the keys to a powerful financial vehicle, but 99.9% of them are choosing to push the car up the hill instead of just turning the ignition.
Exactly. And that friction created vacuum. The private market looked at that 0.067% utilization rate and realized, they were staring at an absolute goldmine. Because the traditional HECM just isn't serving this massive group, so the industry built an alternative. Let's put the old guard, the FHA HECM, right next to the new contender, a Longbridge's Platinum Peak, and see how they actually function.
It definitely helps to ground this by looking at the foundational architecture they share first.
Right, the similarities.
Yeah. With both the traditional HECM and the Platinum Peak product, there are absolutely no monthly mortgage payments required. Second, you, the borrower, retain full ownership and title to the home. The bank does not own the house.
I am so glad you mentioned that because the whole bank owns the house myth is probably the biggest misconception out there.
Oh, it is entirely false. Furthermore, both are non-recourse loans.
Meaning what exactly for the listener?
It is a critical protection. It means that neither you nor your heirs will ever have to pay back more than the home is worth when it is sold. Even if the housing market crashes and the loan balance somehow exceeds the property value, the property stands for the debt.
So your other assets are safe.
Exactly. Now, with both loans, you are still responsible for property taxes, insurance, and HOA dues. And both require you to go through independent third-party counseling before signing anything to ensure you understand the mechanics.
Okay, before we get to the differences, I actually have to stop and admit some confusion here.
Sure. What is it?
The presentation proudly states that with these loans, there are 0 monthly mortgage payments. But then, a few pages later, it lists an APR of around 10%. If I am not making monthly payments, what is an interest rate actually doing? Why do I even care about an APR?
That is the reverse mortgage paradox, and it comes down to a concept called negative amortization.
Okay, break that down for me.
Think of a traditional mortgage. You make a payment every month, and your loan balance goes down, right? It amortizes. In a reverse mortgage, you aren't making that monthly payment, but the lender still charges interest for borrowing their money.
Right, they aren't lending for free.
Exactly. So because you aren't paying that interest out of pocket every month, it accrues. It gets added to your total loan balance.
Oh, I see. So the loan balance is actively growing over time.
Precisely. It is slowly eating into the home's equity. Say you start with a $700,000 house and a $300,000 loan. 10 years later, because of that accruing interest, your loan balance might be $450,000.
Wow.
You still own the house, you still haven't made a single monthly payment, but the slice of the pie that belongs to the bank has gotten larger. That is why the APR matters heavily. It dictates how fast that loan balance grows.
Okay, that makes so much more sense. Thank you. Okay, so the safety rails and the negative amortization mechanics are similar, but the differences are where the traditional HECM starts looking like a relic. Let's talk about age.
Let's do it.
The government HECM strictly requires you to be 62 years old. Platinum Peak drops that requirement down to 55 in most states. That captures a massive chunk of that 53% demographic we talked about earlier.
It really does. It opens the door for early retirees or professionals who just want to downsize and secure their forever home before they officially stop working.
And then you have the lending limits.
Right. The FHA caps the HECM lending limit at $1,249,125, which in major coastal markets or for affluent retirees buying luxury properties, that ceiling is a complete deal breaker.
Yeah, that won't buy much in California or New York.
Exactly. But Platinum Peak shatters that, going up to $4 million, though I should note it's capped at $2 million in Massachusetts.
Still a huge jump. But here is the biggest shocker to me. The mortgage insurance.
Oh yeah, this is huge.
If you use the traditional FHA HECM, you are forced to pay an initial mortgage insurance premium, or IMIP, and it is incredibly steep. It is a flat 2% of the home's value right at the close table, plus a 0.50% annual premium added to the loan balance. With Platinum Peak, there is 0 mortgage insurance.
0.
Yeah.
And if we connect this to the bigger picture, 2% on $1 million home is $20,000 vanished into thin air just for the privilege of initiating the loan.
Just gone.
Yep. The FHA requires this because they insure the lender against that non-recourse risk we talked about earlier. If the loan balance outgrows the home value, the FHA pays the lender the difference out of that insurance pool.
But Platinum Peak is proprietary.
Exactly. Longbridge is taking on that risk themselves, which allows them to completely strip out that 2% upfront fee.
I mean, removing that fee is a massive structural advantage. And it doesn't stop with fees. Think about what retirees actually want to buy. Condominiums.
Oh, getting a condo approved for an FHA HECM is notoriously brutal.
It is. It requires strict FHA single unit approval, where the government essentially audits the entire condo association's financials. Platinum Peak bypasses that entirely by using a standard Fannie Mae limited review process.
And the difference between those two review processes is night and day. The FHA will reject an entire building if the ratio of renters to owners is slightly off, or if the association's reserve funds don't meet their specific calculus.
It sounds like a nightmare.
It takes weeks and often fails. A Fannie Mae limited review essentially just looks at your specific unit and a few basic building health metrics. It removes the bureaucratic nightmare that kills so many condo deals.
Okay, but I am looking at the fine print in the presentation, and I do need to push back on this a little bit. It is not all sunshine and deregulated bliss.
Fair enough. What do you see?
Well, the source explicitly states that Platinum Peak requires a minimum credit score of 550, with extra financial requirements if you are under 660. The government HECM has absolutely no minimum credit score requirement.
That's true.
And even more concerning, the HECM has deferral period protections for non-borrowing spouses. Platinum Peak completely lacks this. Doesn't that make Platinum significantly riskier for certain couples?
You've hit on the catch. It is a calculated trade-off.
Let's spell that out for the listener.
Sure.
If an older spouse takes out a Platinum loan and the younger non-borrowing spouse isn't on the loan, maybe because they are under 55 and the older spouse passes away.
Right. The younger spouse doesn't have that FHA protection to simply defer the loan and stay in a house indefinitely. The loan becomes due.
That seems like a massive risk for couples with an age gap.
It absolutely alters the risk profile. Because Platinum Peak doesn't have the government shielding the lender from risk, the lender demands a baseline credit score to prove financial responsibility. And they simply refuse to take on the actuarial risk of a younger, non-borrowing spouse living in the house for another 40 years without paying off the loan.
Which makes sense from a business standpoint.
Exactly. The FHA HECM is a government-insured product, meaning it is built with rigid, universal safety nets. Platinum Peak trades those specific government safety nets for immense upfront financial flexibility. For a couple with a large age gap where only one qualifies, the traditional HECM is absolutely the safer play.
Right. So you are trading a layer of worst-case scenario government protection for immediate, tangible purchasing power. But, abstract loan limits and insurance premiums are really hard to grasp until you see how they alter the actual physical out-of-pocket cost on closing day.
Very true. We need to look at how this changes the math for you, the listener.
Yes. This is where we look at the cash-to-close game. The presentation gives us a highly specific, real-world scenario to examine. Let's put you in this scenario.
Okay, love this example.
If you are listening to this, imagine you are a 66-year-old borrower living in North Carolina. The date is March 13th, 2026. You are buying a $700,000 home, and you want to know exactly how much cash you have to pull out of your retirement accounts and bring to the closing table to get the keys.
And keep in mind, both scenarios result in you owning the $700,000 home with zero monthly mortgage payments for the rest of your life.
Right. Okay, scenario A. You use the traditional HECM fixed. The APR sits at 10.135%. You have to pay that upfront 2% mortgage insurance, which is $14,000 instantly tacked onto your costs. Furthermore, the HECM has a lower principal limit.
Let's define principal limit quickly.
Please do.
Because of that negative amortization we discussed, the interest eating into the equity over time, a lender will never let you borrow 100% of the home's value on a reverse mortgage. They need a massive buffer to absorb years and years of accruing interest.
Makes sense.
So the principal limit is the maximum percentage of the home's value they will actually let you touch.
And because the FHA has stricter risk calculations, their principal limit is lower. So combining the lower limit with the heavy mortgage insurance, to buy that $700,000 house with a HECM, you have to bring roughly $529,000 in cash to close.
You are essentially putting down a $529,000 down payment to cover the gap between the purchase price and what the government allows you to borrow.
Right. Now, scenario B. You use the Platinum Peak. The APR is actually lower at 9.642%. There is zero mortgage insurance, saving you $14,000 immediately.
Huge savings.
And because Longbridge takes on the risk, their principal limit is higher. They let you borrow a larger slice of the pie. Buying that exact same $700,000 house, you only need to bring about $417,000 in cash to close.
That is incredible.
Here's where it gets really interesting. That is a difference of roughly $112,000.
Over $100,000 in pure liquidity that stays in your bank account.
I mean, that is the difference between buying the home and having your life savings completely wiped out versus buying the home and having a massive six-figure cushion to actually enjoy your retirement.
Exactly. You can cover unforeseen medical expenses, you can travel, or you can just keep that money invested in the market earning a return.
And the market is waking up to this math rapidly, isn't it?
Oh, absolutely. The Longbridge pipeline data in the presentation is incredibly telling.
Right.
Before the Platinum Peak product launched in late April 2025, if you looked at their eligible pipeline from January to May, only 11% of buyers opted for a proprietary product over the traditional HECM.
So the traditional government option was still dominating.
Right. Then they introduced Platinum Peak, stripping away the red tape and boosting those loan-to-value limits. Between June and December 2025, adoption jumps to 39%.
Wow.
And when we look at the fresh data for January and February of 2026, a staggering 49% of eligible buyers are opting for the Platinum product over the HECM. In less than a year, the market share effectively quintupled.
It just proves that when you show someone a math problem where the answer is keep $100,000 in your pocket. Brand loyalty to a government program just vanishes.
Pretty much.
But, this begs a massive question. If this proprietary product is so demonstrably better for a huge swath of buyers, why is the overall market penetration, that 0.067% stat from the beginning, still sitting at a fraction of a percent? Why isn't every single eligible 55-plus buyer doing this?
This brings us to the psychology of the sale and the grassroots ecosystem of the real estate industry.
Right.
You cannot just invent a superior financial mechanism and expect the world to adapt instantly. The presentation focuses heavily on a concept they call the power of choice.
The idea is that you can't just hand a borrower one option and say, take it or leave it. You have to present a comprehensive total cost analysis.
Because think about the psychological baggage attached to the phrase reverse mortgage.
Oh, it's terrible.
Right. For decades, it was viewed purely as a desperate bailout tool for an 80-year-old who ran out of money and needed to pay for groceries. If a loan officer just offers a reverse mortgage out of the blue, the psychological walls go up immediately. People instinctively ask, is it a scam? Or will the bank take my house?
But if a loan officer sits down and presents a side-by-side comparison, like here's the traditional FHA HECM and here are the strict safety nets it provides, and right next to it, here is Platinum Peak, which saves you $112,000 up front, but requires a 550 credit score.
Exactly. Suddenly, you aren't fighting the premise of a reverse mortgage. You are just evaluating features.
You are shifting the mindset from fear to strategic wealth management.
Yes, but presenting that choice requires a massive amount of education, not just for you as the buyer, but for the professionals facilitating the transaction.
And that is exactly where the snippet from the Grassroots Marketing webinar comes in. Rob Cooper shares this fantastic anecdote about a real estate agent, a new home sales consultant who gave a single loan officer 35 to 40 purchases over the course of 5 or 6 years.
Which is incredible volume. How did one agent generate that much specialized volume?
But simply normalizing the conversation, consistently telling clients this is what he does, introducing the loan officer as a specialist in this specific purchasing tool for the 55-plus demographic.
It's brilliant.
35 to 40 homes is a staggering amount of business generated just by removing the stigma and treating it like any other financing option.
And it highlights the core bottleneck. This isn't primarily a business-to-consumer education problem. It is a business-to-business education problem.
Meaning the industry professionals need to learn this first.
Precisely. You have to educate the realtors, the builders, the financial advisors, and the loan originators themselves. I mean, if a realtor doesn't know how a Fannie Mae limited condo review works for a Platinum Peak loan, they are not going to recommend it to their 55-year-old client.
That makes total sense. And notice how the webinar snippet wraps up. They promote an upcoming April 9th session with their non-list servicing committee to address the specific questions loan officers are getting about the post-closing servicing process.
Right? Even the professionals originating the loans are still figuring out how the back end works once the ink is dry.
So continuous, localized B2B education is the only way an entrenched market actually evolves.
It takes relentless grassroots effort to rewire an entire industry to view this as the strategic purchase tool for an active 55-year-old buying a dream home.
So what does this all mean? If you are a buyer sitting in that 55-plus demographic staring down a home purchase, you need to know that you do not have to default to the traditional FHA route.
Not at all.
And you certainly do not have to drain your 401k to pay all cash just to avoid a monthly payment. Understanding the mechanics of negative amortization and knowing that proprietary products exist is the key to maximizing your purchasing power while protecting your liquidity.
And if you are an industry professional, ignoring these tools means you are leaving a massive portion of the 53% buyer demographic totally unserved.
Absolutely.
The demographic wave is already here. The proprietary products have finally caught up to the demographic's needs. Now, the baseline knowledge just has to catch up to the products.
Well said. Let's do a quick recap of the deep dive today. We started by looking at a massive generation of buyers, essentially ignoring a financial tool that could drastically alter their retirement landscape. We dug into the mechanics to understand why the traditional FHA HECM, with its strict FHA condo reviews, heavy upfront mortgage insurance, and lower principal limits, was failing modern buyers.
Right. The friction was just too high.
Exactly. Then we examined how the private market responded with Platinum Peak, stripping away the red tape to offer drastically better cash-to-close numbers. And finally, we saw how grassroots education, shifting the psychology from fear to the power of choice, is the ultimate key to market adoption.
This raises an important question to leave you with.
Oh,
Yeah. Looking at that skyrocketing adoption, jumping from 11% to 49% of the pipeline in less than a year, it really forces us to look ahead.
okay. I'm listening.
If proprietary products like Platinum Peak continue on this aggressive trajectory, systematically vacuuming up all the prime borrowers who have decent credit scores and demand lower fees, will the federal government eventually be forced to completely deregulate and overhaul the traditional FHA HECM program just to survive?
That's a great point.
Or will the government program simply be relegated to becoming the lender of last resort, only serving the highest risk borrowers that the private market refuses to touch?
Wow. That is a fascinating thought to chew on. The private sector is basically forcing the government's hand simply by building a more efficient engine.
You really are.
Well, thank you for joining us on this deep dive. Keep questioning the traditional ways of doing things. Look for the hidden alternatives. And whatever you do, stop pushing the heavy water tank up the hill when you have a perfectly good pool sitting right in your backyard. We'll catch you next time.